the whole thing with insurance is you can't be incentivized to be worth more dead than alive. These are our children's savings account, car fund, college fund, retirement account, all of this stuff. We're building this monster of a policy.
All of a sudden you have this family generation of multi-millions of dollars. It's because of how we think, but a lot of it's made possible because of this product.
We are putting in place a system that is going to be there and is going to be a huge economic benefit for our daughters and their families in the future.
So to teach them the value of the work for the money and how to start to fund their own lives.
Financial education, I think, is the most important thing you can teach your children, because everything they do with their education is going to yield dollars, or should, hopefully. And so you're just missing one of the most fundamental building blocks.
Something we talk about a lot, and something that's become a major theme, is if we want to have a generational legacy, we need to make decisions now that are not even just going to impact our children, but that are going to impact our grandchildren, our great-grandchildren, and even one or two generations beyond that, people that we're probably never going to meet.
It's our role as fathers to make sure that our children also would know what to do with that.
Good morning, Hans. How are you, man?
Hey, good morning. What's going on?
Nothing. Had to take my truck in this morning for another stupid state tax inspection and emission. It's funny that you have to do that with even brand new cars. You buy a brand new car, the next year you have to get it emissions tested. It's what a scam the government is in almost every way.
Yes. I just sold my truck and camper.
Oh yeah. Did you get where you were hoping?
Yeah, I did. I used my I set like my price really high on the ad, and I got basically what was kind of my target, and then came down a little bit on some repairs that needed to be made, because we felt like the actual market value of the truck and camper together is what we agreed on, minus some things that were definitely needing to be fixed. And so it was a good deal, and I wanted the sale to happen and kind of just be done with it. So a little sad to see it drive off. I lived in that for a year in Virginia when I was stationed out there, and every day out there I was like, I'm so done with this thing, I never want to step foot in it again. But then seeing it drive off the lot, I was like, wait, that's mine. It was a weird feeling. I know, but with two kids now, using a truck bed camper, it's just not really practical. And if I don't have the camper, I don't need an F-350.
Did you have a different everyday driver?
Well, in Virginia, I just use my truck. I would disconnect the camper and just drive the truck around. But California, where it's like, $15 a gallon, having an F-350 is very impractical. And just, I'm a truck guy, but like the 350 is so huge, and not often do you need that much. So we've got my wife's car now and don't even drive that too much. So we're just going to stick with the one vehicle for a little bit until we're ready to get the next one, and probably get a bigger one here soon. But glad that the sale is done. And it was a Navy family that's actually PCSing to Virginia and really wanted it. So, dealing with a public sale where Facebook Marketplace, like those kind of sites, how do you just transfer tens of thousands of dollars and feel comfortable giving the keys to someone before the wires have cleared and all that stuff? And it's kind of like, if you're not doing it through a bank or through a lender, through a dealer, it's a little nerve-wracking, giving up the keys or giving up the money, but having that trust that it was someone in the Navy, and he's like an XO of a squadron out here or something. So it was like, felt comfortable, and it was a good exchange. So
yeah, recent history definitely shows us that people in the military should always be trusted.
Yeah. I don't really like the Navy too much anymore, but this was a good guy, good family, and so I felt like it was a good exchange. And now I have another year of premium covered, basically. So
nice. Yeah, I think the Air Force's motto is now, what is it? Integrity last, self before service, and mediocrity in all we do.
Yeah, exactly. Career preservation is the core value of the Navy, as we saw since COVID.
I went down to to a conference in Orlando for that Tom Woods put on. And if you haven't ever followed Tom Woods, you guys should check him out. His podcast, it's absolutely incredible. It's libertarian podcast, but he runs the gamut. He talks about business, he talks about libertarian stuff, he talks politics, he talks history. It's an awesome podcast. But he put on what he called an unconference, where unlike most conferences where it's all scheduled out, he just had 3 rooms and you could sign up to pick the thing you wanted to talk about if you wanted to talk about something. And then from there, all the attendees could look across every 30 minutes, they can move rooms and attend whatever they wanted to listen to. And so there was people talking about everything from, I can't remember what it's called, but it's like worm horticulture. I can't remember the term for it.
Vermiculture.
There it is, vermiculture. That's right. Yeah. So there was everything from vermiculture to, I talked about the infinite banking concept. People were talking about taxes. People were talking about businesses, mindset, health. It was cool, man. It was a awesome time. Yeah. So I got back from that a little tired, and I'm still feeling it. I slept in today, but I'm still dragging from all the travel.
Yeah.
Anyway, yeah. So one of the things I talked about in my presentation there was, somebody, and a more elderly person was saying, well, can I do this at my age? And I actually said, maybe, it depends. They weren't really all that old. They were in their upper 60s. They could still practice this. And I said, but if your health is a limitation, you have other options. So when we're practicing infinite banking, we don't have to take the policy if that's our method, which is the best method. We don't have to take the life insurance policy out on ourselves. It can be somebody who we have an insurable interest in, like we talked about before. It can be your spouse, your business partner. If you're young, it can be your parents. It can be your kids, grandkids. There's even potential for other family members if you have like a guardianship or something like that, an insurable interest. But the key there is, it even lit the guy up whenever I said, if you have grandchildren, you can take policies out on them as kids policies. And it's a phenomenal option that isn't necessarily great for the short-term use, but the long-term potential is out of this world on these policies. And you just recently having your second baby, have just opened one. I opened my last kid's policy up 4 years ago for my family when my son was born 4.5 years ago. But yeah, man, so when you started that, since you've done a very, very recent child's policy within your own family that you could talk about at will without uncovering anything, what were the guidelines on you to be able to do that?
Yeah, so there's a couple things that are different with the child's policy. They're not going to go through and do the full medical underwriting like you would do for an adult. It's basically, do they qualify or not? And there are some medical conditions that could disqualify them, but if they do qualify for any insurance, they qualify for the same rating. So they're all going to be a standard rating, and you also can't put a term rider on it, which is how we are able to get more of that type of premium we talked about, the paid up addition, to make it increase that cash value earlier. You can't put that term rider on there, so you are limited in how much percentage of your premium you can put into the paid up addition. But that's okay, because we have a low time preference here. We're looking long term. These are our children's savings account, car fund, college fund, retirement account, all of this stuff. Like we're building this monster of a policy if we take a long time frame. And so it's a little bit different in the immediate application that we talk about when we're setting up policies for clients and the conversations we're having. We're thinking a lot longer term here, because my daughter is 2 months old now. The earliest you can underwrite is 2 weeks for most companies. So at the 14-day mark is when I hit submit on the application, and maybe 10 days later she was approved. And so it's a little bit different. So we're going to talk through some of the considerations there, and then we're also going to talk through what we want to do with this long term, and also what it could cover, what could be a substitute for in the conventional financial planning model.
I do want to say one thing there, is that not being able to attach a term rider is with most companies. I do believe there's a couple out there, none that we typically write for, that will add that on. So I'd say with most of the companies that work well with this, that's true. And there are a couple exceptions where you can add one to get a little more PUA in.
There's a few more, I guess, a few more quick criteria. Generally speaking, that up to half of what the parents are insured for is what you can insure the child for. And the other one is you can't insure your children by significantly different amounts to where there's different, the whole thing with insurance is you can't be incentivized to be worth more dead than alive. You're just making yourself whole. And so when I put my daughter's policy in force 2 years ago, my first daughter, I knew that with future children, I'd have to be in the same general amount of coverage. I couldn't apply for drastically more or drastically less with future children. So that's something to think about if you're insuring your first child.
Yeah, I think whenever you insured your first child, we actually talked about that when you were talking about how much you wanted to do. And I said, just be aware, because I learned that lesson. I didn't realize that when I first started practicing infinite banking, I took out small policies, what I could afford, because I started with a policy on me, my wife, and I had 3 kids at the time. And so they had small policies. Well, I made significantly more money when my 4th child was born, which was, a few years later. And when I tried to take a policy out on him for more money, the company was, like threw the stops at it and was just like, why do you want to do more on him? And I said, well, because I can. And it was just like, well, you only did this much on your other ones. And so I had to bring it down to the same level. So now, and I've even seen the same thing with clients. I mean, one client that I had, they had 3 children, and we only put applications in for 2 of them. And they came back and said, well, why aren't you trying to insure child number 3? And that child actually did have a medical condition that was disqualifying. So I sent a little statement about, what the child's medical condition was. And it was like, okay, cool. And they approved the other 2 right away. But they'll question that. Like, why do you want to insure these 2, but not that one, or this one and not that one? And you have to justify that because they want to make sure there's parity across all of them. It's just suspicious. The fact that they can't do any kind of deep dive into the underwriting.
Yeah, they're kind of taking a leap of faith a little bit almost.
Yeah. So a couple of things to think about with the kids, but yeah, the time preference you mentioned, you've got thinking long term with these. One of Nelson's principles is absolutely paramount.
They're maybe 60-ish% of the premium is the paid up addition. And so there is cash value immediately right away. And we can use those just like any other life insurance contract. It's just, we're not immediately getting the huge growth that we might with an adult policy. But again, these are contracts that are going to be paid until my daughters are 95. And so you think about the growth over the long term, and we talk about the uninterrupted positive compounding growth, where this is the only vehicle you can get that for your whole life. Well, we're talking about decades and decades here. And so these numbers aren't eye-popping off the bat, but a couple of interesting, I'll use my first daughter's policy as an example. And the things that stood out to me when I looked at the guarantees was when she's 18, at that point where hopefully she decides not to go to college and understands why it's not a good fit for her. But if she does decide to do that, she will have a couple $100,000 available to her. When she's my age, her net worth just from this policy is higher than my current net worth. And when she's 65, her retirement pool of money just from this policy, if she does nothing else with her life, is going to be several $1,000,000. And so I went knowing that I didn't want to start too small for the reason that you mentioned. I went probably bigger than might be recommended on her policy. But again, I didn't commit myself to the entire premium, because if you understand that we don't have to pay the PUAs. And so I chose a chunk of required premium that was manageable with the goal of paying the whole thing, obviously. And now my daughters will have this pool of capital that I can use until I transfer the policies to them. And in the future are just going to be monsters, which is really, really cool to think about. I'm actually way more excited about their policies than mine.
Yeah. And that makes sense, because something we talk about a lot, and something that's become a major theme, is if we want to have a generational legacy, we need to make decisions now that are not even just going to impact our children, but that are going to impact our grandchildren, our great-grandchildren, and even 1 or 2 generations beyond that, people that we're probably never going to meet. But if we could set that up now, think about, like, we just had a conversation with a client. We both did. We were, virtual conversation where it was looking at a child's policy, and that child was 6 years old. And it was kind of like, well, I could maybe do more with this in my policy now, and some of that sort of thinking, and just talking through the value of the policy. And it was just like, okay, well, you're 32 years old. Just simply look at this policy when she's 32 years old, 26
Mm-hmm.
years from now. Let's go to that line in the ledger. And if I think it was $5,000 or $6,000 a year or something for this particular one for their kids. And it was like, when you pay that premium on that day, when your daughter's your age, she's going to pay $5,000, and it's going to increase by more than $30,000 of available cash value.
Yeah.
Do you wish you had that in your life right now? Do you wish you had something that you could pay on, what's today? June 24th, I could pay my premium of $5,000, and on June 25th, whenever it clears the wickets and shows the new values, it's 30,000 bigger that you have access to. I would love to have that right now. I don't have anything giving me that kind of return in the world, because we started this so late. So now you think about, like, and if you teach her these principles, she probably has a 6-year-old at that point in time who she's now been doing a policy on since month 1 of that baby's life. And when that baby's 32, what's it going to look like? And what's it going to look like? And what's it going to look like? And all of a sudden you have this family generation of multi-millions of dollars, not all because of, it's because of how we think, but it's a lot of it's made possible because of this product.
And that's her savings account again. And that's, we always have to bring people back because we're so spring loaded to think about investing in returns. But when you're talking about that 6x return, that's on your savings. That's not even showing what you're going to do with it. And he'll get those returns in his policy eventually. It's going to take time. The way that we can structure it, we can bring that earlier than, say, 32-year mark, but it's going to take time for him to get there. So like that, if he understands the value of what he's putting in place for himself, and then we expand the time frame for the children, you understand how powerful this actually is.
Oh yeah. And then of course there's the death benefit, which we should never look past, but that's what's going to continue that generational legacy as well. On top of just how much you can do it in your life over time, over the course of it. Because look how fast our lives are flying by. We both had a birthday this month, and it's just like, you look backwards, you're like, how did that happen so fast?
Yeah.
So the time goes quickly. You might as well make smart moves with it. But that long time horizon is so important, man. And I'm not even talking about the long time horizons of our lives. I think we need to be looking into generations we won't see. There's that old, I forget who was it that said, we plant trees in the shade of which we'll never sit under.
Yeah.
I can't remember who said that anymore, but it's a great thought. It's really a great quote.
Yeah, it is. And it's what's interesting to think about is, I'm assuming both of our general family network, like in my upbringing, I'm now having to think about, I will have to think about things that weren't really considerations with my family, such as, when my daughters are going to get married, I'm going to be very discerning, obviously, and involved. I mean, not like saying who they're going to marry, but I'm going to be very, I'm going to really pay attention to, like, hey, my daughter has this huge asset that like my wife didn't have, that I don't think my sisters had. Like my parents are very responsible, and what I'm trying to say is that this idea of bringing millions of dollars to the table is foreign to me. And in everyone in my network, it's like, I don't know anyone in my strata that has had, in addition to screening the potential suitors for your daughters down the road, it's kind of this foreign concept to me of, well, not just that, like, as a man, are you a good provider? Are you a good, solid Christian man? But, you also have to understand money. And that's something that I don't think is often, like wealthy families do that. And they vet, and they have all these systems in place to make sure that, financially you're not incurring any risk by who you marry within the family. And we think that's kind of like elite and way out there. But, now I'm going to have to think about, am I ready to sign over this policy to my daughter's husband down the road? Like, do you know how to manage this? Because this is a lot more money than I've ever seen by that time. We fast forward down the road, I didn't get that when I got married, and I don't know anyone who did. And so, it's just an interesting, it's like we're getting back to the generational piece. We are putting in place a system that is going to be there and is going to be a huge economic benefit for our daughters and their families in the future. And it's a cool way of thinking of generational wealth. Like we're leaving a lot behind.
Yeah. And I'm saying like, and that's exciting to me, even though like it's a little bit troubling, or not even troubling. It's a little bit frightening to like look out and be like, what if they blow this? But man, how exciting, because we can put a lot of things in place to ensure or hope that they don't blow it. And yeah, and if you know, if one of my daughters or sons marries a knucklehead who I don't have a good gut feeling about, or I feel they're not educated enough, or you know, they just, maybe they're not good stewards of money. Yeah, there will be probably some new provisions written into the Moody Family Trust.
Yeah,
that will mitigate that potential for interrupting the compound interest.
So let's compare this to, say, a 529. That's probably the most common way that people save for their children's futures right now. And all of this discussion, it always comes back to compare to what? So let's compare this to a 529 plan. Again, most people that are putting money away for their kids are doing so in a 529 plan. So first of all, what's a 60-second overview of a 529 and how would this stack up against that?
Yeah, the 529 plan, once again, anytime you see these numerical plans, you should automatically have a little alarm bell going off in the back of your head of, why is it a numerical plan? It's probably part of the government tax code, right? So it's going to be a creature of the IRS. Well, a lot of the IRS tax code is written there for business owners as ways for them to keep more of their money. But when it's a numerical code for a place for you to put money that is associated more with employees than employers or entrepreneurs, you should enter that with a certain level of skepticism. What am I gaining? What is the government gaining? Is this actually good for me? And have they created the problem that they're now trying to give me a workaround for? And I think the 529 is exactly that. What the 529 is a government-sponsored program that will allow you to save money in a similar fashion to like a qualified plan or a 401k. It's an after-tax contribution, and it grows supposedly tax-free, and you can use it supposedly tax-free for your children's education. But it comes with a whole lot of restrictions. Do you know any of those?
Well, primarily, you got to use it on education, and the definition of education has expanded. They're giving a little bit more leeway in what you can do with it. But in its simplest form, if it used to be that if you don't use it for college, then it's not going to get you the same tax benefits, and now it's going to be taxed. Your gains are going to be taxed like they were in a normal brokerage account. And that's an argument I've heard for it, is that, hey, if you're willing to save this money and invest it and take it out, tax free anyways, why not put in the 529? And that way, assuming you use it for education, then it becomes tax free. And that's okay. That's a small, that's something, but that's not optimal in my opinion.
Yeah. And it's not just that. I mean, you pay a penalty as well if you take it out on the gains. And you don't use it for college, on top of you pay the taxes. And the biggest thing to me, and because I had 529 plans for 3 of my kids when I discovered IBC. So they weren't huge. I hadn't put a ton of money into them, but they did exist. And I think the taxes I paid were virtually zero. And the reason is they all went down with the market at some point. I forget which year it was that they lost a bunch of money. Somewhere, maybe it was 2017, kind of a bad year in the market, because if memory serves me right, that's when I closed them. But I was basically just withdrawing my basis. Yeah. So, what if your child, we have to go back pretty far right now because the stock market's been crazy with all the inflation and the inflated currency and the amount of liquidity in the market. But if you went back in time to 15, 16 years here to 2008 and you had saved in a 529 plan, you might not now have enough money to send your kids to school. And you can't really delay that. Or you're going to tell them, you can't go to college until the market recovers. Right. It's all market based, which means every single penny you put in these plans is at risk.
Yeah. There was someone on Twitter that said, here's a great financial hack to make your kids millionaires. Put in whatever, $500 a month into a 529. And then when they're ready for college, they'll have $27,000 that they can use. If they decide not to go to college, then you can roll it to a Roth IRA. And by the time they retire, they'll have $1 million. And I was like, well, Maybe. What if they don't? What if none of that happens? And what if they go to college? This hack to become a millionaire. Now they have $27,000. That's like a semester. So they have big student loans. They have a pointless education, but 27,000 of it was funded without paying taxes on. It's like that line of thinking used to resonate with me. It no longer does because I don't see the value in college in the first place. I certainly don't see the value of going into debt for college. And what if you don't get those returns? Like in your case, when you not that you needed the money, you decide I'm going to pull this out and stop contributing to this plan where the government is the middleman here. There was no gains, and so what if there aren't those gains? It's like just this idea that putting money into the market is magically going to grow it, and
It's always
then
going to work. Always.
you get this wonderful perk of a tax advantage. It's like, well, okay, well, we can offer that. My daughters aren't going to deal with taxes on the gains in their life insurance contract, and they don't have to use it for school, and they can do. I can use it in the meantime, and it also is going to multiply eventually. Either their spouse, their children, someone's going to get many, many, many multiples of what was put in there, unlike the 529.
Yeah, well, and the other problem with the 529 is as soon as you take that money out, you're interrupting the compound interest. If it was true compound interest, but you are interrupting the growth. So as soon as you make a withdrawal, take that money, even if it is for college, and you get all the tax advantages of the 529. They do exist if it all works out. Like I can't deny that. If everything works, you're getting a tax advantage. Your kids decide to go to college, the market was up. It's all, so there's an advantage there. You're not going to pay tax on those gains. So, but then as soon as we use it and spend it for their tuition, their books, or whatever it is that you're spending it on, it's gone. And therein lies, if we always go back to what's the problem that IBC solves, what's the problem that nobody acknowledges financially?
It's that every other vehicle is a single use of money, and it extinguishes the principle when you use it for its intended purpose.
Yeah. And that it's back to that initial problem that I always talk about, is that you finance everything you buy. And so this is the side of the opportunity cost, because you have essentially paid cash. When you diminish that fund, you take it out as cash and transfer it to whatever institution. Now that's their cash in their bank. The bank is once again the person who wins, and you have nothing, and all that money is never going to grow for you again. So it grew for a while, and then you got rid of it. Whereas we're going to mitigate that in our contracts because we're going to leverage it to pay for the college. There's one more huge benefit. I think there's even more huge benefits, but since we're kind of spitballing on it, one more huge benefit I can think of is anybody that's applied to college or has done it for their children or is going to, you have to fill out a form called the FAFSA, FAFSA. Do you remember what it's called? I can look it up real quickly, or what it stands for, because it's not jumping out at me.
Federal
Application for Student Aid or something like that. Yeah, something along those lines. But they're going to look at all your financial assets. There's one asset for sure that doesn't show up and that they're not allowed to count as part of your net worth: whole life insurance. But if you have a 529, that counts for how much money you have. Now, whenever you apply to FAFSA, which you have to do before you go to college, if you want student loans or grants or any of that stuff, they're gonna look at all your net worth and determine if you guys qualify. And you are more likely to qualify for either better loan provisions, different kinds of grants, different kinds of student aids if you show fewer assets and lower net worth. Well, all that net worth still exists in your life if it's in the whole life insurance contracts. It's just not available for the federal government to see. It's private. Whereas if it's part of the 529, well, that counts against you, because they're like, well, you have this money to pay for college. Why would we give you a grant? Why would we give you some more money? So you're actually hindering your own possibility to help your children pay for college at a lower cost.
Yeah. And of course, caveat with all this and all of our content, it's not financial advice, but we would be interested if, like, I can't think of any advantage that the 529 would have over doing it this way. We would be interested in knowing what those are. Obviously, people are very passionate about their 529 plans. They love the government being the middle manager between them and their capital. If there is advantages that we're missing, we would definitely love to know that. But in my mind, I don't see any argument that would make a 529 even on the same playing field as doing this.
Yeah, there's no advantages that tip the scales anyway. They have some small advantages out there compared to just saving cash in a savings account or a checking account and just paying cash. There might be, as long as the market's up. Like I said, you've lost that advantage. Even if it goes down, the risk is not worth it, in my opinion. But there can be advantages. They just don't tip the scales, in my opinion. But, one of the problems, and that kind of the last thing I can think that I want to say about 529 is one of the problems is that it is earmarked for a specific purpose. It is earmarked to go to some kind of higher education. And like you said, they're given a lot more latitude and what that means. It's not just university like it was when it first started. But what if your kid just says, Dad, I don't want to go to college. I think a 4-year degree is useless because I don't want to be a part of the oppression Olympics. What then can, you're going to pay those taxes and penalties, but now you have a pool of capital sitting in it. If you didn't use that and you utilized a whole life insurance policy, you have a pool of capital sitting in that policy. What can it be used for?
Right. What if you said, okay, I do want to go to college, but I'd rather use this money you've saved for me to purchase a duplex, and I'll rent out half, and I'm going to buy a cash flowing asset and I'm going to use that to fund college. Well, that's definitely something you can do without diminishing your principal in a policy, but it's something that you can't do if you have the 529. And so again, it's always compared to what, and I think that you could certainly, like you said, you can make the argument about the 529 being superior than just saving in a high yield savings account for that time period. But I don't think it stands up at all in using a child policy down the road when we've got this incredible safe pool of capital for them.
Yeah, I agree. And we can use it for any number of things. And just for like a quick list, what if they like that rental property possibility? Oh, I'm going to buy an asset that gives me monthly income that will pay back the loan and pay part of college. I can purchase my first adult car potentially. Maybe I want to start a business and I need to buy a truck and a trailer. Whatever business it is. Dad, I'm going to start a landscaping business, but I can't afford the trailer and the equipment. All right, we're going to take a policy loan that you're going to pay back with your revenue. What if they do get married young at 18, 19, 20 years old and they want to put it for a down payment on a home? Oh, you can do that without penalty. Cool. The point is, it's the infinite banking concept because it's infinite. They can do anything with it without the government saying, whoa, that's not what we created this for. So you got to pay a penalty and taxes. So, right. I mean, not even comparable in my opinion. I don't even know if it's still worth talking about. So
I know.
So yeah, my wife had a State Farm policy that was taken out on her somewhere in her first year of life that was transferred to her. And I didn't even know this when we got married that she had it. And I didn't even know about it, I don't think, until after we started doing IBC. And in all those years that she had it as an adult, she used dividends and growth in the policy to pay the premium. But the dividends were less than the premium when she started. So it was eating into cash value from the day she took it over. And I'm talking 15 plus years. I have no idea exactly how long that no outside money was going in to pay the premium. So my point in telling you that is it was completely stunting with the interest rolling into the loan and eating into the policy, stunning the growth of this policy. It was a $5,000 death benefit taken out, over 40 years ago. And it was $56 in premium. Well, once I learned IBC, we paid off the loan. We contacted a State Farm agent. We had them change it so that the dividends would start buying paid up additions, which they had never done in the entire life of the policy. So there was never a paid up addition bought from day one for 40 years, not 40 years, 30 some years. Now in 2024, we paid $56. I think it was in March. That's the month she was born. So the premium was due in March. We paid $56 and it immediately got us an $86 increase, which is like a 53% return on that money. And I'm talking about of the 43 years it's been in existence, for 37 of those, it was used in a suboptimal and paid for in a suboptimal way with no dividends ever helping the policy along. And it's still performing at that level. So what if that was used correctly and it was a $500 a year policy taken, which would be substantial on a child in 1980. What if that was the case? That thing would be tripling, quadrupling every year, if not more than that. So, we're seeing it even with a policy that was used incorrectly for the whole time it was in force almost.
Probably 12x a high yield savings account at the moment when you put those dollars in. And like you said, that was after forgetting it, neglecting it, and using it suboptimally. Well, of course, that's a great place to put your money. That's such an efficient way to save money that you know is going to be returned to you down the road. You can still access it, and a 53% return in your savings is unheard of anywhere else. And so, like, it's just hard to imagine a better use of money now, and that's because the time has gone in, and even suboptimally, that that time in the market, or excuse me, that time in force in the policy was not subject to market ups and downs. It was just the steady growth of a policy over time, and now 50-ish% in your savings. Again, I can't emphasize enough how powerful that is, where your savings are multiplying more than any market return could ever do, especially more than any kind of high yield savings vehicle. It's just so powerful. And in my daughter's policy down the road, we're doing it optimally because we started it with an understanding of IBC, and so just we're giving a blessing to future generations, when that money's paid out, whether we're here or not. Like, that money's going to return many, many times over. It's such an awesome way to set your children up.
Yeah, definitely. So kudos to my in-laws for putting that in place. I just wish that we all knew how to use it better all those years. And I'm so thankful that, I learned this via what Nelson Nash wrote.
And one thing with that I thought that resonated strongly with me when I was looking at the illustrations for my daughter's policy and putting those in force was, you and I both had a decision to make a couple of years ago regarding the mandates. And are we going to die on this hill, basically, knowing it's going to cost us our careers? Or are we going to, what we were giving up at the time with what they were threatening us with, beyond saying court martials, paying back flight school, all these things that they threatened us with, was that, all right, I'm not going to get a pension now. I'm not going to make the 20 years. You were already there. You were almost there when everything started. And so you'll have that. But, this decision we had to make of, would you give up your pension to not take that shot? Right? Which people might have thought was crazy at the time. People don't think it's that crazy anymore. But what we've done by setting our children up in this manner is we've ensured that they will never face that decision of, am I going to give up my pension, my career, in order to hold the line on what I consider a moral imperative? And that's a decision that we've removed the possibility of them facing, because when my daughter's my age, like I said, if she has to make a hard decision like that in her work, she can walk away knowing that her retirement's already funded just by having this policy in force. And so that's we've taken that out of the equation for them. And we learned that lesson the hard way by having to face it and make that decision. But it's awesome to be able to relieve them of that in the future.
But dude, I'm thankful we did face that because of the lessons learned that we can now push down generationally about that. So we've liberated our kids from locking themselves into something they might not want to be a part of, or a job they don't want, or something like the military. We've liberated them from having to feel like they're stuck and imprisoned for a pension, for a way of life, financially. So, dude, it's huge.
Now, a big point that is often made is, you hear about trust fund kids, you hear about kids squandering money. You don't want to. It's kind of this mindset of, well, I don't want to leave my kids with a ton of money, because then they don't learn the value of hard work. They don't, they didn't earn it. You hear a lot of celebrities now saying that, I'm not going to leave this money to my children. I'm going to leave it to charities. My children need to learn on their own. And so, are we going to be spoiling our children by leaving them millions of dollars one day? Not just through their own policies, but the fact that, if we were to die tomorrow along with our spouses, our kids would all be millionaires many times over. So is that just going to spoil them before they learn the value of hard work, et cetera? What are some thoughts on that?
I think it really comes down to how much of this like generational thought process we actually talk about and keep in the family, how much we teach them. And how much we give them. I'm still trying to get my kids to start businesses. We're looking at next year for my son as he matures a little bit more, because we're in a pretty hilly area, to start just a lawn care little business in the neighborhood. And so to teach them the value of the work for the money and how to start to fund their own lives. But There's three places that I've learned a lot that's really been changing my thought process that we are going to incorporate into the remnant finance I don't know, processes, if you will, with our clients and something we want to teach them. But one is with Jason Lowe, and he talks a lot about family banking. He's a Canadian practitioner that you guys should look up. And he brings his entire family into so that they're all funding the Lowe family bank and so that they're all part of it and they all understand what they're doing. Phenomenal what he's done. The other place is another company that's in our arena called Factum Financial. And like, I've become friends with the CEO of that company, Kyle Fuller, and he shared with me his Fuller family constitution that he wrote. And I'm in the process of writing my own family constitution that I'm going to include, well, three of my kids more so, because I don't think my 4-year-old's going to have a lot of big input into the family constitution, but he'll be there for the talk. And my wife and I, and we're going to talk about what are the values and what are the most important things and what are the things that we want 4 generations from now to be thinking about. And a book I'm reading right now, I don't have it here at my desk, it's upstairs, was written by a woman named Rachel Marshall, and she's part of the Money Advantage podcast. It's called 7 Generations Legacy. And she's talking about really the same thing that I sort of picked up from Jason Lowe and Kyle Fuller, but she's really put it down on paper as a nice plan. And it's the same thing. It's what are our family values? And I think if you make that a core discussion of who you are and where you're going and what that means, for me to be a Moody, for your family to be a Tui, and what that means generationally, I mean, they shouldn't be able to mess it up.
Yeah.
It shouldn't be a trust fund baby who runs into money and goes out and does drugs and screws up. It really should be like, oh, we are now stewards of what was created. And we are going to think about our great grandkids. I'm talking about our kids and their kids. They're going to be thinking generations that they won't meet. And when you're making decisions that are 100 years into the future or more, you're really thinking differently, and you're making different kinds of decisions, because it's not about what can I do right now for this month and this week and this year. It's, man, what can I do for people I never meet? I really think it'll teach the right stewardship. That's what I believe. That's what I hope.
Yeah.
Yeah.
And like with your 4-year-old or my daughter's, 2 months and 3 years are their ages right now. Like they don't know anything about, they don't know what money is. Right. And so, yeah. So if I die tomorrow, that's the importance of the trust right now. I have everything delineated of how it's going to go. I'm putting these guardrails in place for them before they're able to learn this knowledge and how to wisely steward what I'm leaving them. But once they're able to understand, if they were to get this money and blow it, that's my failure as a father. That's me not teaching them. I view it as my responsibility to make them understand as soon as they're able to and be wise stewards. And if they're not at that age yet when it does happen, then again, my trust and the guidelines laid out there and my trustee who is going to be managing that, those are the guardrails I'm putting in place before I can teach them these things. But down the road, it's not going to be a burden or this curse on them to get this money. It's not like the lottery winner that doesn't know how to manage money and just blows it in 6 months. You think about yourself, if I'm 36 right now, if I were to all of a sudden get an inheritance of, $10 million or whatever, would that ruin me right now? No, because I have the knowledge and understanding of how to preserve that, grow that, and ensure that works into my system that I've already got in place. And that would be a huge blessing to have that inheritance. It's our role as fathers to make sure that our children also would know what to do with that. Had it been, say, 5 years ago, if that had happened, I wouldn't have blown it. I would have applied it in the conventional financial planning model that I thought was the way to go. I wouldn't have blown it. It just wouldn't have been as optimal. But I do know people that if they got that, it would be a curse on them. But that's because they don't have the knowledge. And so we will do an episode on trusts. We want to do an episode on how to, how these principles can be passed down and how to actually to teach people think about money and talk about money, especially with your family and your children. But if your kids as adults would get this money and blow it and it would be a curse on them, that's a failure on us as fathers, is how I see it.
Especially when our children are young, I don't want to, the thing I want to say about that is, like, you might be listening to this and you might be, let's say, in your 50s and your kids are in their 20s, and you didn't learn these financial principles because they just weren't out there, or you didn't hear about them, or you didn't learn them from your parents. And it's still, I think, your responsibility to introduce it to your children. You're not necessarily able to control whether they grab onto it or not, whether they catch it or not. They may never want to listen to what you're saying when it comes to money here. And I don't think that makes you a failure, but I still think it's an effort that should be made. And you can still put frameworks, legal frameworks, and the trusts and things in place to make sure that it isn't blown. But yeah, I agree with you in that with young children, it is our moral imperative, since we have this knowledge, to pass it on.
Yeah, and financial education is totally and intentionally absent in school, because I believe the goal of the public education system is to get you to college, and the goal of college is to get you in debt so that you will be a good worker.
That's right.
And neither of us believe in the public school ecosystem, and so I think it's intentional that they omit an understanding of what is capital, how does it flow, the power of banking, the value that we have gained in our lives by learning this. That you can go through 20 years of official education from kindergarten to a doctorate and not even understand the value of leverage and how to flow money. And the numbers on student loan debt versus income, et cetera. I mean, that's not even deniable at this point. So financial education, I think, is the most important thing you can teach your children, because everything they do with their education is going to yield dollars, or should, hopefully. And so you're just missing one of the most fundamental building blocks. And that's what we want to make sure that we are the ones that teach them that, not the state.
Yeah. And, I actually want to talk about, when I was at the Tom Woods Unconference this weekend, there was a gentleman there. I was just looking up his name because it's escaping me at the moment, but he has a website which you should check out, especially homeschooled, but anywhere here. His name was John something. I apologize, John, if you ever listen to this, but I just drew a blank on your name. But check out middleschoolmba.com, middleschoolmba.com. And he has basically created entire coursework, which was like, his presentation was fascinating about it, to teach kids economics, business, entrepreneurship, financial, personal finance type stuff, and something that schools just do not do so kids have some basic understanding of what entrepreneurship is. And he does it from an Austrian economics perspective and more of a, let's say, libertarian perspective. He's a successful businessman, so he's lived the life, and it was just like, hey, let's teach kids how to do this because nobody else is. So there is something out there, even if that's not you. I mean, check out that program. I thought it was awesome. I'm going to look into it for my kids, as a matter of fact, here in the coming days.
And say the name of that program one more time.
Middle School MBA, Mike Bravo Alpha, MBA.com. Yeah, it was absolutely, it was super, super cool. So I think it's worth looking at if what we're saying here is resonating with you about the schools not teaching anything, and maybe you don't have a huge background in this, then you could probably go through that program with them and learn something yourselves. It's not really designed, it's not a kid's thing. I think even adults could learn from it, from what I could derive in his talk. Yeah, man. So if you're interested, or, if anybody out there listening is interested in learning more about what we're talking about, writing these family constitutions, we're going to be writing letters to our kids and setting up systems that plan out multi-generational. We can help you with establishing and coordinating and getting in touch to do the right living trust and legacy trusts. That's something we're passionate about, and we'd love to help you. But really, it all starts for us with savings, infinite banking concept, these policies. It's a great place to get all the money started on the financial side.
Yeah, and hopefully you're excited about what you can do for your children by setting them up as infinite bankers and getting policies on them. But we want to make sure that you, as the primary breadwinner, are insured first as far as the order of operations here. So before you get too far over your skis, let's make sure that you are covered and your family is protected as the breadwinner of your family. Let's get you covered, and then we talk about children's policies, because they are really powerful. And I'm my two policies that I'm most excited about are my two daughters' policies, just because that time is its own form of energy as far as a policy goes, and so having decades to look at, it's incredible.
Yeah. Well, hey, I'm gonna have to run now because I want to hurry up and get some applications done on my kids and expand their systems. So I'm all excited about it now, and I got to get it in before the office closes.
Yeah, sounds good, man. Well, we'll wrap it up there. I think that's a good starting point for children. We'll hit on it in future episodes because it's always going to come up when we're talking about generational wealth.
Yeah, for sure. All right, brother Abe. It's good talking.
All right, man. Sounds good. We'll see you.
See you next time.
Cheers.